Hello, today let us look at the statement of financial position, which was commonly known as the balance sheet. Okay, so people still refer to it as the balance sheet, but it is basically the same. It is the statement of financial position. And so, like, what does a balance sheet show, or rather, a statement of financial position? It usually has the assets. It shows the assets in the business, the liabilities in the business, and the equity, okay, the components of equity in the business as at a given point in time. Okay, it's very important to know it is as at a given point in time. So we are looking at the balances as at a given point in time. What do we mean by this? What do we mean by this? We are saying, like, let's say, for example, in a business, you are looking, let's say, in the period ended 31st December 2025, right? So you want the balance sheet is going to show us as at that day, that is the 31st December 2025, what are the assets balance, what are the liabilities balance, and the equity balance as at 31st December 2025. Okay, so we are not looking at the assets that you've during the period, let's say from the period January to December 2025, if you've bought some assets, you've disposed some other assets, there's been the inflow and outflow of assets and liabilities and equity during that period. Okay, we are not going to be looking at that inflow. No, we are looking now as at 31st December 2025. What do you have? Do you have like a laptop worth this amount of money? Okay. Do you have like a motor vehicle that is for assets? Okay, these are assets. Do you have a motor vehicle worth the net book value? Do you have a motor vehicle worth this amount of money? Okay. If it is the liabilities, you want to know, this is the account payable you have balance as at that 31st December 2025. These are the amount of people that have not paid you. This is the that you are yet to pay. Sorry, that you are yet to pay. If it is the bank, again, because this is a liability, you have this loan that you're yet to pay. Okay. Then also in equity, you're able to see this is the share capital we have as at 31st December 2025. These are the retained earnings. Okay, so we are only looking at the balances as at 31st December 2025 for this for example. Okay, so remember then the accounting equation. What does the accounting equation state? It states that the assets in a business will always be equal to the liabilities plus equity. Okay, will always be equal to liabilities plus equity. And this statement usually shows the assets, liabilities, and equity as at a particular point in time. What does that mean? Every time you prepare that statement of financial position, or rather the balance sheet, you'll find that the assets will be equal to the liabilities plus equity. Okay, they will always be equal. So one thing to know, if you've prepared your balance sheet correctly, then always the assets will be equals to the liabilities plus equity. Okay, another thing, let us see how we arrive at the balance sheet. How do we arrive at the balance sheet? Remember the accounting cycle. After you've recorded the transaction during the period as they happen, okay, you have the transaction, you've recorded it, you passed the necessary journal entries. Okay, so you've passed the journal entry, which will be summarized in the ledgers. Okay, and as at this point, you're able to get a trial balance asset that 31st December 2025, for example. Okay, remember the trial balance also shows the balances, the account balances as at a certain period of time, a certain point in time. Okay, not period. Okay, it shows the balances, what you have as of that day, what is the balance in that account. Okay, so it always, also for the trial balance, the debits will always be equal to the credits. If they are not equal, then it means there are some adjustments that need to be done. Then you need to correct errors. Okay, there is also what we usually have, that is a period end the period end adjustments. Okay, in this at this point, remember as well, if you have any error that you need to correct, you do it as at this point. The examples of period end adjustments, these are, for example, you need to do depreciation for that period. Okay, if you have non-current assets or PPE that require that you need to share, that has a certain useful life, and you need to expense it over that period of useful life, you do the depreciation. We have, these are examples of what you're going to expect, the period end adjustment that you need to do. Okay, allowance of expected credit losses. This is what was commonly known as the allowance or provision for doubtful debt or for bad debts. Okay, so credit losses, that's another one. Okay, here you also check any prepayments, adjustments, any accruals that you need to do. Remember, you're using accrual method of accounting. Okay, so you have to check in depending on the scenario of the company. You have to make sure you do all these period end adjustments. Once you do those period end adjustments, then you're able to come to get the adjusted trial balance, which now you use to prepare your financial statements. And in this case, we are going to start with the balance sheet, or rather the statement of financial position. Mostly you're going to see people, when preparing the financial statement, we start with the balance sheet and then we go to a statement of profit or loss. Okay, so first let us look at how we prepare the balance sheet. Now, after getting let us use this example. This is KM Traders. We have now done the period end adjustments, and by knowing so, you're going to see there's some depreciation here. Okay, so once you've done that and you've passed the journals to cater to those period end adjustments, then you're going to have the adjusted trial balance as at 31st December 2025. Remember, again, I said the trial balance shows the balances as at a given point in time as well. Okay, they show the account balances. For instance, when you look here, when you see cash, you see this is cash in hand. Okay, this is cash in hand. This is cash in bank. Okay, this is cash in bank. So what we're saying here, cash in bank, it means you have this physical cash in your safe. For example, if you're in an office of 15,000, okay, that is the balance you have, not the amount of money that has been going in and out during the period. No, if you want to see that, you have to pull the whole the old transactions, the old journal entries past, or rather the entries in the ledgers. That is going to show you the inflow. Okay, but now we are looking at the balance at the end. What is the balance? Okay, so these are the trial balance is basically telling you as at 31st December 2025, the cash you have, physical cash you have in your safe, for example, is this 15,000. In bank, it is this 35,000. Okay, in the account receivables, meaning as at this particular point, these people owe you, you're expecting to be paid 22,000. Okay, these people, as at this point, you've sold to them these goods or services and they are yet to pay you an amount 22,000. Inventory balance, okay, is 48,000. This means that is the closing inventory as at 31st December 2025. Then we have prepaid insurance. Remember, this is also an asset, meaning you paid for insurance, but these are what as at 31st December 2025, you have not utilized 3,000. So it is an asset during that period till you expense it. Okay, then we have office equipment. Office equipment, this is your PPE, this is your non-current asset. Okay, so as at 31st December 2025, this is the value of this office equipment. You're going to see here we have accumulated depreciation. So for you to be able to get the net book value, remember we record the net book value. Okay, you're going to take this 90,000. You're going to take this 90,000 and you're going to less the accumulated depreciation. Remember, accumulated depreciation is what you have depreciated in the previous period and the current period. So to get the net book value, you take the buying the initial cost of this equipment U less the accumulated depreciation, and now you're going to get 72,000 as the net book value for this equipment, okay? Then you have the account payable. This is a liability. This is a liability. Then you have a bank loan as well, is a liability. So as at 31st December 2025, these are the people who have not paid you. This is the these are the things that you've not paid, because this is the account payable. You have not paid for these things. Then you have the bank loan. You've not paid that loan. Then you have accrued expenses, meaning you have incurred some expenses but you've not paid. That's also a liability. Equity, capital and retained earnings. This is basically equity. So we are saying as at 31st December 2025, this is your capital. This is your share capital, okay? And these are the retained earnings as at 31st December 2025, okay? Then you have revenue. You have revenue. Revenue, remember, when you're recording revenue in an account, you're basically, when you sell a goods worth 100,000, you credit sales revenue account. So this is not a balance. This is basically all the revenue that you've earned during the period. Okay? As well as any expenses. These are expenses incurred during the period, okay? So these ones, we use them in the statement of profit or loss. Remember that you're not going to find revenue and expenses in the statement of financial position. No. These ones you use, these are expenses during the period, and they go to they're going to be useful in the statement of profit or loss. Statement of profit or loss, okay? So as we want today to prepare the statement of financial position, that is, have the assets, the liabilities, and equity as at 31st December 2025, okay? So let us start. The first section, always make sure you include the title. The statement you're preparing. Remember, the financial statements is a set of 4 statements. So you make sure you include the one that you're preparing as of right now is a statement of financial position, okay? Now, let us look at how do we go about it. Let's start with the first section, which is the assets. So you write their assets. This is in dollars. Okay. Then you're going to have, let us combine these as cash balance. Okay. So basically this, we add 35,000 plus 15,000 and just have it as a cash in balance, whether it's physical cash and cash in bank. Okay, so here we have a cash balance of 50,000. Okay, so first let's start here. Remember, we classify the assets into 2. That is the current assets and the non-current assets. Remember, for current assets, these are assets that are going to be utilized within a period of 12 months. For non-current is the ones that you're going to utilize might take more than 1 year or 12 months to utilize, okay? So definitely for cash, it's something like today you'll be having cash, tomorrow you're paying something, tomorrow you're receiving more, okay? So cash is something you utilize in a very short period of time, okay? So here we have cash balance. We've seen we have $50,000, okay? Then here we have account receivable, an amount of, remember, account receivable is those things that you've sold and you are yet to be paid. We are expecting these people to pay you, okay? Then we have inventory, that is 48,000. Before I continue, for account receivable, so depending on the business that you're running, and the significance of the amount, you need then to always have a period adjustment of allowance for expected credit losses, where you come and less that allowance that you've provided for in that period, okay? So we are going to look at another example where we have an allowance for bad debts or for expected credit losses, okay? So let us continue. For inventory, we have 48,000. Then we have prepaid insurance. We have prepaid insurance. Prepaid insurance. Also an amount of $3,000. Remember again, for current assets, these are assets that are going to be utilized within a period of 12 months. You can see cash is something you utilize within a short period of time. Account receivable, you don't expect someone to stay with your money for a period of more than 12 months. You're not going to be in a business where you're selling and giving someone credit for more than a period of more than 12 months. Inventory as well, you're buying inventory to sell. So you're not buying too much inventory again to just keep there. You want to buy inventory this month and sell it the next month. Prepaid insurance mostly is usually on a period of 12 months, okay? So it's just that you could buy it on, let's say in July, and it is ending the next period, the next year, June, and maybe you're closing your accounting period is December. So you will have a prepaid insurance that is going to go to the next period. But in the current period, that is an asset, okay? So here we have, let us calculate total current assets. So total current assets will be, we're going to have here a sum of 50,000 plus 22,000 plus 48,000 plus 3,000, which is going to give us 123,000. That is our total of current assets. Now let us look at the next section, which is basically the non-current assets. Remember, the non-current assets are the assets that you will be utilized in a period of more than 1 year. Okay. So for example, office equipment. Office equipment is something that you're going to use for a period of, you're buying for example, a table to use for a period of more than 1 year. You're going to buy your laptop for doing business to utilize at least for more than 1 year, your machine, your projector, such things. Okay. So here we have office equipment. This is basically, for example, your laptop. Okay. So an amount of, remember we record the net book value. That is why we took the buying cost. This is the initial buying cost of this equipment, and we less the accumulated depreciation, which is the depreciation from the previous periods and the current period, and we get our net book value of 72,000. Okay, 72,000. Okay, so basically the total non-current assets are going to be 72,000. Okay, so let us look now at the total assets. Let us look at the total assets. That is a summation of the current and non-current assets, which is going to give us 195,000. Okay, so note we have a total assets of 195,000. Okay, now let us look at the next section. Let us start with equity. Okay, so here we have equity. And here we have two components of equity. We have in our case capital. We have capital, and we have retained earnings. So our capital, we have a balance of, it means the capital that is in the business as at 31st December 2025, you have 120,000. And we have retained earnings of 11,000. Okay, 11,000. So that gives us total equity. Total equity is basically 120,000 plus 11,000. So here we have 131,000. If you are having trouble identifying the accounts that are assets, liabilities, and equity, then check the link on my bio. There is a course that I have done to guide you to understand what are assets, what are liabilities, and what is equity. And you're going to understand the component. What do we mean by capital? What do we mean by retained earnings? What do we mean by current asset? What do we mean by non-current assets, including the examples? There's a link on my bio on my YouTube account. Just click on it. It is going to direct you to where you will get the course. Okay, so at this point you should be able to just look at the accounts and know this is a liability, this is equity, this is an asset, this is a liability, and understand what it means. Okay, this is an expense account, this is a revenue account. Okay, you should be able to understand that. It is crucial for your basic understanding of financial accounting. Okay, so check the link, go purchase the course first before you get to start preparing the financial statements. You need to be able to understand that and the accounting cycle as well. Okay, now let us go back to the liabilities. Let us go back. Now we look at the liabilities. So again, for liabilities, we have current and non-current assets. Okay, so let us start with current liabilities. So in our case, what is the liabilities we have? You can see here we have accounts payable, we have accrued expenses. These are current liabilities, because for the bank loan, remember this is long term, so it's a period of more than 12 months. This is going to be a non-current liability. Remember that current liabilities are the liabilities that you can settle within a period of 12 months, but for non-current liabilities are the ones that will take a period of more than 12 months to settle. Okay, so these are within the period of 12 months to settle. This one you're going to take more than 12 months to settle. Okay, so accrued expenses is basically those expenses that you've incurred but you're yet to pay, and accounts payable, again, you've bought something and you're yet to pay. So our current liabilities in this case, we have the account payable. What is the balance? The balance is 20,000. And we have the accrued expenses. They have the accrued expenses, an amount of 4,000. Okay, so our total current liabilities. What is our total current liabilities? We're going to have 24,000. Then let us look at the non-current liabilities. We've seen we have a bank loan. A long-term bank loan. An amount of 40,000. So in total, what is going to be our liabilities? What is going to be our total liabilities? Because the total of non-current liabilities is basically 40,000. So total liabilities will basically be a summation of 64,000. That is basically the 40,000. We add the current liabilities, which is going to give us 64,000. Okay, so we ask ourselves, what is the total of liabilities plus equity? What is the total of liabilities plus equity? That is total liabilities. That is total of liabilities plus equity. So we had our equity total as 131,000. 131,000, and we have our total liabilities of 64,000. When we add 131,000 plus 64,000, what do we get? We get 195,000. Recall what was our total of assets? Our assets were 195,000, and our liabilities plus equity we have 195,000, and that is how a balance sheet should always be. Remember, a balance sheet, we are going to have the assets of the business. The assets in the business are going to be equal. They're going to be equal to the liabilities plus equity. Okay, that is very key. Remember, for you to get the cost, to be able to understand what are assets, what are liabilities, you just come and check the link on YouTube. That is Accounting and Finance Playbook account YouTube. You're going to get a link that is going to direct you here, where you're going to come and click buy now, fill in the payment details, and then you're going to get this course that has pre-recorded